Maybe you could share after I've done the introduction.
Oh, sorry. Okay.
No worries. Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. We'll be beginning in the next 1 minute to allow additional people to join us. Thank you. Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. My name is Damaris Mukulu, the Head of Brand Marketing and Communications at Genghis Capital. We are glad that you could join us today, June 14th, which is a couple of days since the national budget was read. I'm sure our Head of Research, Chachil Ogutu, will have some commentary for us. With us is the rest of the research team, that is Wesley and Melody, and they'll also be joining the conversation when it comes to fixed income and the equities market. They'll be sharing with us the performance of the previous week, as well as the expectations for this week, including the trading recommendation for both fixed income and for equities. We'll also have, hopefully, Matthew Kabire of FXpesa EGM Securities join us. As you're aware, Genghis CDS clients have a special opportunity to engage in the global financial markets. So if you have a CDS account with Genghis Capital, you're able to trade on the international front when it comes to indices, precious metals, and other such assets. Our webinars are interactive, so we encourage you to use the Q&A tab. Please send in any questions you may have for the group of researchers we'll have join us shortly. You could also use the chat box for any comments or concerns you have. This video will be uploaded to the Genghis YouTube channel in case you have to drop off at some point or you miss any part of the presentation that you would like to revisit. I think we are ready to begin, and for today we will start with equities. So Melody, over to you. So Melody, we can see your screen. Maybe you could go into presentation mode and then unmute yourself.
Just a few minutes.
We've lost you.
Hi, Damaris. Sorry, could you give me just a few minutes? I seem to be having an internet.
Oh, okay. Certainly, we can definitely give you a couple of minutes to sort that out.
Damaris,
guys, please hang in.
Let me start. I think I've managed to sort my issues. Morning, everyone.
Maybe Wesley could assist. My internet is having a bit of a problem.
No worries, Melody.
Okay, so just go on with.
Today is a special Monday indeed. I thought I had Churchill who said he wanted to begin with the macroeconomic outlook, but I think Wesley, you may be up.
Sorry for that. My network seems to be having a problem.
Happens to the best of us. Okay, I believe Churchill is going to start us off, Melody. So we'll do the usual format of macroeconomics, fixed income, then equities. Churchill, over to you.
Thanks, Damaris. Morning, everyone. Sorry about the hitches today. Special Monday indeed, as Damaris has said. So as usual, I'll start with the macroeconomic, and then I'll get into the fixed income, and then my colleagues will chime in on the equity side. So kicking it off, the review for last week, whereby things are just moving, yeah. So whereby the highlight of the week was the presentation of the budget statement by the CS for National Treasury, whereby we are looking at the overall estimates was around 3.64 trillion, broken down into budgetary allocation to the national government, that was around 1.95 trillion. What is going to the consolidated fund services, another 1.17 trillion. And then the county equitable revenue share, another 370 billion. But having said that, there are usually some two numbers on the budget, either the gross estimates or looking at the expenditure and net lending. So ideally, the difference stems from the fact of how redemptions are treated in the budget. So if you knock the redemptions, debt redemptions, which is another 600 billion, so it's coming to expenditure and net lending at 306 trillion. Thereabout. So whichever way you look at it, perhaps you've had the budget that was presented was 303 trillion or 3.64 trillion, and then you get confused. But ideally, it's just one is the gross estimates, the other is expenditure and net lending, which the latter is just knocking off the redemptions. Ordinary revenue, we know it's at 1.78 trillion in the next financial year, which is an increase of 181 billion. But having said that, we have the finance bill, some of the proposals in the finance bill, and the CS was crystal clear, saying that it will amount to only 8.7 billion shillings. So you can imagine we are getting into an environment whereby the ordinary revenue is increasing by 181 billion, but even the tax proposals in the finance bill is just a paltry 8.7 billion, which is roughly 4.4% of that 181 billion. So the other difference, 173 billion, is just underpinned by the growth assumptions that have been put by National Treasury, where last year was a bad year, or the previous year, the current financial year was not as rosy as what is expected in the next financial year. And with that, even the ongoing tax revenue streams are expected to pick up in the next financial year. How realistic the growth projections are is entirely a different webinar. So for now, those are the numbers we're looking at. Finally, the net financing in the next financial year, we're looking at close to 930 billion, whereby domestic borrowing will be another 658.5 billion. An increase from 540 billion that is in the current financial year. So what will it mean to the government securities in the next financial year? Already we could see a crowding out of the private sector, that lending to the private sector. As at April, it was at 6.8%. CBK is anticipating it to be at around 11.3% by the end of this year. But of course, with an increase in government borrowing, that will obviously have a negative impact to that achieving that goal of the private sector credit growth. So that is just a glossing over the budget statement that was presented last week. And in tow, and what is a bit surprising is that supplementary budget 2 estimates were also tabled last week on Tuesday. So ideally, we have a budget like this budget statement that has been presented for the next financial year. And then we have in-year revisions or adjustments to the estimates are now called the supplementary budget estimates. The first one had an increase of 83 billion shillings to the allocation to the national government. And then right now with the supplementary budget 2, we are seeing a reduction, a net reduction of 8.6 billion shillings. Of course, there are some sectors, there are some MDAs which have been affected the most. Think of university education. I've seen a slash of 17 billion to university education. Obviously, because most people have been operating from home, even the unis. So the funds that they were expecting, perhaps the internally generated funds, was not able to come to fruition. So that's one of the things that stood out. So collectively, with the adjustment in the supplementary budget 2, we are seeing that what had been allocated to the national government has now been trimmed back to 1.96 trillion. So that's the import of the supplementary budget 2. But of course, I think that it has to be tabled and it has to be approved before the 30th of June, because there's no sense of approving a supplementary budget in the next financial year. So it's a race against time in the sense that we have to approve the budget for the next financial year. The finance bill has to be approved, and yet again we have this supplementary budget too that has to be approved. So a race against time before in the next 2 or 3 weeks before the end of the financial year. Moving on to another issue that stood out for us is now the disbursement to the order of 750 million. So this is the third development policy financing by the World Bank. It's part and parcel of the financing in the current financial year. Of course, the World Bank funding has some objectives, and therefore that are attendant to this particular financing. So the first one is regards to the fiscal and debt reforms. So what do we mean by that? Is likely they are looking at even from the procurement stage. It has to be quite transparent. There's a talk of Public Procurement Act that even the CS alluded to in his presentation last week. And that's one facet of that, fiscal reforms. The other is now even within the monitoring and evaluation of the projects. There's also, it has been put into laser focus. So collectively, these issues to do with procurement and also the monitoring and evaluation is expected to lead into some cost savings of around $2.6 billion. That's around 280 billion shillings in the next financial year. So it's just to see how they'll be realistic, these fiscal reforms. The other issue, the first part is now the debt reforms, and that also touches on the fixed income market. So what the World Bank has proposed is that there could be some transparency in the primary auction, not just to favor the commercial banks, but just to bring a lot of transparency through that process of auctioning. This week we have the primary bond auction, and not many people know the process around it. So the World Bank is quite categorical that going forward, there should be some transparency in that process, and also in the secondary market trading, a bit of some transparency over there. So that's the first arrow in the World Bank objective. The second one is around electricity sector reforms, and that is mainly touching on Kenya Power. And broadly, they're looking at cost savings in the order of $1.1 billion over 10 years, so 121 billion shillings to be realized as cost savings to Kenya Power. So that is a bit constructive. Having said that, we've seen even from the IMF reforms in that facility that they gave us. They're also looking at state-owned entities, the ones that have been losses, and the ones that are posing the largest fiscal risks in the country. And Kenya Power also stood out. So we are seeing Kenya Power being affected by two different programs. That is, on one hand, the IMF, and also the other hand, the World Bank reforms. The last two are touching on national capital reforms, just basically the climate change governance. And then the last one is now on human capital reforms, and basically an NHIF Act is expected to be in place. I think this is already in the public domain. There's been a bit of hullabaloo around NHIF bill that is expected to be put out there. So I don't know whether it's part and parcel of these reforms by the World Bank. But anyway, it's just a matter of speculating. But time will tell if at all is part and parcel of this World Bank reforms. So that is it in regards to the review for last week. Moving on to this week's calendar, not much. It's quite light, of course. Just the Parliament will just pick on where they left, and also the proposals that the CS presented last week. But mainly today we're looking at the April monthly fuel pump price review, starting from the period tomorrow all the way to 14th of July. So that will be the main news to keep an eye on. Of course, we're still patiently waiting for the economic survey to be released, and also some of the unemployment data to be released. So moving on to the fixed income markets, we have secondary market T-bonds last week rebounded 19% to close to 16 billion turnover last week. The trades were majorly on infrastructure bonds. That has played out in the last couple of weeks. On the T-bills, we saw the overall bids that were received was 43.6 billion. That was a performance rate of 181.8 billion. And these levels are the levels that you saw at the beginning of the financial year. That said, yields declined across the tenor. This is a theme that we've been parroting over the last couple of weeks. Since May, we've seen that the yields across the T-bills tenor have been coming down, in the sense that in as much as the bids that have been received at the auction, weekly auction, are above the 24 billion that is being sought, we've seen that a large proportion of that amount has been rejected, and that is where the latitude for lower yields has come from. And to be sure, since start of May up until the last auction, we've seen that the yields have declined on average 0.37%. So that has now brought the year-to-date net increase in gains down to 0.27%. At some point, we are looking at 0.54%, but it has gradually come down ever since May, that inflection point, start of May. Getting on to the liquidity trends, last week, all the liquidity trends pointed towards an improvement in liquidity. The first indicator is now the interbank market. It declined on average 0.47% to 4.31%. The other indicator that we track is now the open market operation, whereby majorly CBK was coming to mop up the excess liquidity. It does that through term auction deposits. Between Monday to Thursday, it was majorly on 7-day and 14-day. And then on Friday session, it came 7-day, 14-day, 21-day, 28-day, though we haven't seen the results yet. So the results we have in terms of the 7-day that were accepted between Monday to Thursday, it was around 23.25 billion at a weighted average rate of 5.54%. And then on the 14-day, it was 19.25 billion at a weighted average rate of 6.24%. Overall, our net domestic borrowing is around 448 billion, which is around 83% of the revised target in the current financial year. But having said that, our calculation is usually the net, how we arrive at our net domestic borrowing. We just look at what was accepted by the CBK, and if there's any redemptions whatsoever, we net it off. And that is how we've been doing it from the start of the fiscal year up until right now. If you flip it and how the CBK Treasury tracks it, of course, there are some net domestic borrowing, which are not necessarily government securities. And as at May, they're already at 400, as at March rather, they're already at 465 billion. So from that perspective, and looking at the trajectory, we had an IFB in April, we have some new issues in May, they are more or less closer to reaching the targets. And that is also speaking to what I spoke about in the previous slide, this latitude, that the T-bills yields have started to come off. That is an indicator that right now the government is sitting at a comfortable level in terms of its debt borrowing trajectory so far. So, and that now leads into the week's trade, the reopening of these two bond issues. Remember what we said earlier last week, that these two bonds are heavily discounted in the market, in the sense that their pricing is below, for every 100, their pricing has been below that 100. So for instance, if you have 100,000 and you're looking at these bonds, most likely you'll end up paying 98,000 thereabouts, as opposed to over 100,000 in some of the bonds that you've been seeing of lately. So to us, even the reopening of these two bonds is just at least to encourage that liquidity to these two papers. So overall, the target that is being sought is 30 billion. The auction will be this Wednesday, and the implied yield on the FXD1 2019-20, this is the first 20-year paper that was issued in 2019. The implied yield is at 13.17 as of the end of last week. We are recommending bid range between 13.35% to 13.49%. For the second paper, this is the first 20-year paper that was issued in 2012. The implied yield as at the end of last week was at 12.51, and there's usually the inverse relationship between the yield and the coupon. So if the yield is higher than the coupon, I will see that the price of the bond is at a discount, meaning that for every 100,000 that you want to invest, you're likely to invest lower than that 100,000. So that's where the discount is coming from. So the recommended range for this second paper between 12.75% to 12.8%. So that's about it from fixed income. Damaris, I don't know whether you were at this point you're supposed to talk about Family Bank bond, or we'll talk about it later.
We'll talk about it later.
Okay. Yeah, Damaris will present to us family bond, corporate bond. So
I will, in the interim, I'm going to say in the interim.
All right, so we now move to equities. I don't know whether Wes or Melody, you are ready. You can walk us through this.
Good morning to you. On the equities, a recap from last week, we saw the NASI up 1.4% to 172.33, and the SC20 also rallied by 20 basis points to 1911.92%. The turnover of the week went up by 108.3% to 4.8 billion. The top gainers were Transcentury, NBV, the Business Venture, GB, and laggers were Sanlam and Express. Notable announcement through the week. One was Crown Paints. On Thursday, Crown Paints rights issue started training. The company plans to raise 711.8 million by issuing 71,181,000 new ordinary shares at a price of 10 shillings per ordinary share. The rights issue is at a 74% discount on Friday's closing price of 38.6 shillings. The goal of the rights issue is to lower debt and finance expansion projects on other markets. Also on Tuesday, we saw President Uhuru in Ethiopia seeing the formal awarding of the telecom license to GPE, and Williamson T issued a profit warning, expecting at least a 25% lower earnings to the previous year. That's it from my end. Thank you.
Hi, team. So for this week, the focus has mainly been on the budgets. So of note is that CS Yatani requested approval for temporarily stopping disbursements of funds to county governments that have consistently been failing to pay suppliers. He also ordered that county governments pay their pending supplier bills, which is amounting to around 346 billion by June 30th, 2021. Which from our side, we see it's very unlikely to happen. And because of these delays in payment, it ends up affecting the cash flows of suppliers, which in turn ends up affecting their ability to service their outstanding loans effectively. So looking at the stock market, like the banking sector side, we've seen that equity closed at 44.05, which was close to its 52-week high of 44.4, and it was mostly traded by foreign investors. And that leads us to the recommendation of the week, which is ABSA. It's been rallying and it closed at 10.10 shillings, and recommend a hold on this counter. We've seen that its non-performing loan ratio stood at 7.5% for the first quarter 2021 against the sector average of 14.6%. And also the bank intends to invest in technology and digitization by putting aside 1.6 billion to roll out around 60 different technology projects. So in our view, we see that this will boost non-interest revenue, and it will also enhance cost optimization. We also see that it has a dividend play to it because it pays dividends as well. So for me, that's what I had from my end. Back to you, Churchill.
Thanks. I think we are done. I don't know whether Matthew's on the call so that you can walk us through the global markets.
Yes, Matthew is on the call, but let me take this time to just walk guys through the family MTN. So let me share my screen. I feel like a researcher. One moment. Okay. So hopefully you guys can see this particular artwork. So in 2015, Family Bank issued its first bond, and I believe, if I'm not wrong, they successfully redeemed it earlier this year. And Genghis, along with NCBA, is actually proud of the fact that we're helping them raise a second medium-term note. So they're hoping to raise 3 billion, but I believe they'll take bids up to 4 billion. The really great thing is that this is a fixed coupon rate. So the return is going to be 13%. And 13% is payable semi-annually. So twice a year, these payments will be made out. Of course, this return is gross of withholding tax. That's the tax you pay to the government for interest accrued. So the other good thing is that the minimum investment is 100,000. So if you wanted to join the fixed income market but find the returns for these other bonds and treasury bills to be a hindrance, this is the perfect opportunity. The only thing you have to keep in mind is that this is a limited time offer, so it's closing on June 22nd, which I think is just 8 days from now. The only thing you need is to have an active CDS account where you would deposit the amount, the investment, and then from there we would provide you with the application form. So it's as simple as, do you have a CDS account, you fund it, and then you fill in an application form. And once the offer is closed, this particular MTN will be trading in the secondary market. So I think that's pretty straightforward. If you want additional details, we have the pricing supplements, we have the information memorandum, we even have the abbreviated notice. So just reach out to us on marketing@genghis-capital.com, and we'll be happy to share with you this particular opportunity. I think of note is the fact that Family Bank has managed, despite the economic situation, has managed to really perform well. So this is your chance to get on board and take advantage of this particular MTN. So that's me, short and sweet. Matthew, over to you.
Hey, Damaris. Hey, everyone, and welcome to this briefing today. Damaris, you've done it quite well, so you're quite a researcher as well. No doubts about that.
Thank you.
Right, so sharing my screen, let's look at what we have at the global markets. Well, the S&P, last week's recap, S&P 500 reached an all-time high after the CPIs. That one is an indication of the inflations. So it came more than expected. It made the S&P 500 spike up. So it rose by 5%. Sorry?
Let me jump in and say we're not able to see your screen. So maybe you could try and reshare the presentation.
Okay. Sorry about that. Yeah, we good now?
Yes, can see it. Thanks.
Okay, thanks for that. So last week's recap, S&P 500 reached an all-time high after the CPIs went up, rose by 5% year on year. That is for May. And that one as well made the US bond yields go to 3 months lows. So CPI figures, they are at the highest level since 2008. And of course, this is as a result of the base effects. Remember, base effect is when you're looking at the current results of the data as compared to a time when they were quite low from 2020. That's the reason why the Feds are saying that, or they have been holding on the idea that the inflation is transitory because of the base effects. But clearly, it's been rising 5%. That's what caused a spike of S&P 500. And the bond yields went down. On the European side, the ECB, they left their rates untouched. They were steady, but the expectation of having the parties to continue increasing until the end of March 2020 is still on. So that one makes the euro a little bit maintain the weakness, right? So Canadian dollar, it hit the 6-year high, and what contributed to that is the rising commodity prices. Sorry about this. For some interruption there. Yeah, the commodity prices have been going high, especially for the oil. Remember, Canadian dollar is a commodity, like a commodity currency. So when the commodity prices are high, or the demand is increasing, then it also becomes stronger. So it's been going higher and higher, stronger across its pairs. So it's among the top performing currencies. You might want to check out and see where you can take an opportunity out of that. So this calendar is quite packed for this week. The calendar is quite packed for this week. And of course, we have a lot on the US and on the UK, also something on Japan on Friday. So let's keep watch of that. Key things here to look at is the US core retail sales, of course, producer price index, manufacturing, and for the UK, we have the Bank of England governor speaking, unemployment rate, that is for Tuesday, right? So even today, something coming up. So there is quite a lot for the UK, quite a lot for the US as well. FOMC, remember, this is where we're going to hear of the directions that the Feds are going to take on the FOMC. Remember, this meeting is much awaited. So what is likely to give the direction in terms of the economic projections, terms of the monetary policy and what we are what they're expecting to do in terms of inflation, and that's going to give a direction. That's informs why we have a pound USD as the key or as the choice instrument to look at this week. Again, on Thursday, something on the Australian dollar. RBA, we have Governor Lowy speaking, unemployment rates. That's going to speak on the outlook of the economy as well. Swiss National Bank, for the ones who are trading on CHF, that's one is going to come in handy. You know, US Philly Fed Manufacturing Index is quite important as well. So we have this calendar is packed this week, and it's an indication that we're likely to have quite some volatility in the markets. So, you know, when that one is there, when you have volatility in the market, then it is an opportunity for you traders, and as well, it's as well a signal for you to be careful there to try and manage that risk. Because of course, high volatility will come with opportunities, and as well, it comes with risk. So check out on those currencies that you have these impact events, high impact events. So let's look at pound USD. That is the instrument of choice, the currency of choice is weak, and of course that's because of the events which are coming up on the UK side and also on the US. Of course, pound was able to hit a 3-year high at the start of June, because on the side of UK there are recoveries thanks to the ramped up vaccinations and the opening up. So the pound has been strengthening as at the beginning of June. Its GDP grew by 2.3% from 2.1. Now, what you're looking up to this week, of course, have you seen on the calendar, is the US retail sales and quite some other key data coming up. Okay, and the UK data again on the CPI and retail sales. That's going to influence the movements of this pair, that is the cable. So looking at this one, you see the oscillators, they're showing a little bit of, is it a moderate momentum, or like we don't have a strong upward momentum currently. It's within a range. So you see it's between 1.42 and 1.40. And it's just playing along the moving average. So what we want to see as traders for us to get a clear direction, and of course it has to be after these events come up and we see the results. It has to break above the 420 level for traders to consider, and hold above 420 for traders to consider opportunities, long positions up, maybe out the ways of 1.428. But if it breaks below the 1.4072, then looking for short positions, but we have a support level sitting around 1.400. So we want to see how the cable breaks either above that range or below that range for good positions. Currently, it's below the moving averages. So key level to watch is the 1.407 support, right? Next, I want to look at the index, US 30 roll index, or the Dow Jones. So looking at the moving averages, we have a 20, 50, 100 moving averages there. It has tried to just break below the moving average, but it's holding in between the 150, as you can see there. The oscillators are showing some kind of that index struggling to gain some upward momentum. So the key levels we're looking at here is 34,300. It has held strong support. That is since May. It's still holding on that support, and there has been weakness in having this index rising up. So for a good position, good long position, it's good to wait and see once the price action goes above the moving averages. That will be a good indicator, especially above 1.347, at least for an opportunity to take a long position And of course, the key resistance level towards there is 3,592. Yeah, but if this weakness continues, anything below 3,400, that one is going to give a strong indication or strong opportunities for traders to short. So the CPIs is what has really been on the watch, especially for this index. So we saw it increasing to 5%, that is inflation. And the sentiment from the Feds on whether they are likely to rein in on the purchases and start curbing, trying to control the inflation is what is really going to influence these indices. So should the Fed say that the US is rebounding and now they want to start capping and making the dollar strong, then of course it's likely to hurt the stocks. If it hurts the stocks, then it's going to be reflected on this index, because of course an index is a tracker of the performance of the stocks which are already put in here. Of course, for the Dow Jones, the top 30 stocks traded in the US markets. That's what we have. What I have for this index here. On the company's earnings report, of course, we have these ones here. You can revisit this presentation later and refer on the ones that you're likely to see some movements. When the earnings are coming up, of course, they will indicate, of course, out of the results, you will know where you can speculate and take some positions. Still on the dividends, we have some companies that are likely to announce, and this one here is the expectations or the forecasts. Of course, you know, you have to compare the previous and whatever the results come up and the forecast that we've already been having. If it's better than expected, then it's giving a positive sentiment for you to get in and look for a good opportunities. So that's what I have for this week. Let's dive into the questions. Over to you, Churchill. Over to you, Damaris.
Thank you so much, Matthew. Thank you so much. All right, guys. So dive in straight to the Q&A questions that have come in, quite a number of them regarding MTN. If I had known all along, I would have been making presentations at these briefings. So the first question was from George Murage. He says, can we explore the Family Bank Corp bond? I saw it in the news yesterday and Genghis was promoting thoughts. So towards the end of the presentation, if you look in the chat box, I've actually shared some information that you can review. It includes the notice, the pricing supplement, and the information memorandum I alluded to earlier. So that will give you an overview of the particular medium-term note. George also asks, how long is
Damaris, perhaps I can just expound, because a number of the questions on the Q&A is just related to the Family Bank note. So let's just start from the beginning. The Family Bank note was done by the corporate finance deal. So what happens, there's usually some Chinese walls between corporate finance and also the other departments, such as research. So we are not even pertinent to the deal up until when it was public. So there is usually some strict Chinese walls. So looking at, now that it's public information, looking at even the bond itself, Family Bank is a repeat issuer in the sense that it issued its first bond in 2015, and then it retired in, I think in April this year. So now they are now coming back again for the corporate bond market. There are two facets to it. What will happen and what Damaris alluded to earlier on is that for the clients for Genghis, at least so long as they have been able to fund their CDS accounts within Genghis, they can now be able just to send instructions to the client relations, and then after that, they'll be actioned on that. So that is one facet to that. But nonetheless, for every client, whether you're a Genghis client or you're not a Genghis client, you'll have to fill in some serialized form, which is just unique to you, indicating your bid that you want, whether the minimum amount is 100,000. So if you want to enter it in at 1 million or 2 million or whatever, you'll be given a specific account form whereby you'll fill in the details. So if you want a fixed rate, Damaris spoke about the fixed rate bond initially, which let me just go to it, which is around 10%. So it will give you a fixed rate coupon of 13% every year. So that's if you want the fixed rate option. If you want the floating rate, so they look at the 1H2-day T-bill. Remember earlier on, I just glossed over the T-bills by itself. But so the pricing for the floating bond is benchmark on the 1H2-day T-bill, and then there's 2.5%. So for instance, the 1H2-day T-bill as at the end of last week was around 7.9%. So plus 2.5%, you're getting close to 10.4% thereabouts. But having said that, there's a coupon floor on the floating rate, and then there's a coupon ceiling, in the sense that the coupon floor is around 12.5%, and then the coupon cap rate is around 13.25%. So if the 1H2-day T-bill plus 2.5% is below 12.5%, you'll receive the 12.5% during the interest payment. And if it's higher than 15%, it's capped at 13.25%. So that is the floating rate option. So as an investor, you'll have the option of either going to the floating rate or the fixed rate. Fixed rate is at 13%. Floating rate, it just goes on between 12.5% all the way to 13.25%. And then the tenor of the bond is 5.5 years. Remember that the full tranche that Family Bank is looking is 8 billion, of which right now the first tranche they're looking at 3 billion with a green shoe of 1 billion shillings. So in the sense that from the book building, that is what is being done. The book building, which is ending next week on 22nd of June. If it's been able to realize 3 billion, that is the amount it will get. If it's if there's some interest around that, so the green shoe option kicks in, so it can just take an additional 1 billion over and above the 3 billion that has already been done. So you're looking at a total aggregate amount of 4 billion that is being sought in this first tranche. We don't know the specifics as to when the second tranche will be done, but ideally for this round of the issue, they're looking at the 4 billion, 3 billion plus a green shoe option of 1 billion, so collectively for 4 billion. I hope I've been able to clarify some of the issues that have been raised, Damaris.
You have, Churchill. Maybe we could talk about the taxation and any risk involved, and then we can move on to other questions.
Okay, yes, taxation, because it's below 10 years. So in the Kenyan law, any bond below 10 years is taxed withholding tax of 15%. So 15% withholding tax will be applicable on every semi-annual coupon payments that you receive. So that is what will be applicable. Risks, well, let me just put it because it's a repeat issue. Remember that it's interesting time that Family Bank, when Family Bank issued its coupon bond back then in October 2015. Then we had Imperial Bank had issues the month prior, and that is when Family Bank came in with issuing its corporate bond. It was not successful as such because of the issues that prevailed along the Imperial Bank. And then a couple of months down the line, Chase Bank also, which had issued a corporate bond, had issues. But the thing with Family Bank, because it's a repeat issuer, is not run-of-the-mill issuer that is coming to the market. At least you've seen the track record. So people who had invested earlier on and exited in April, we haven't seen issues related to Family Bank as an issue. Remember that corporate bond market, right now, there are just a few issuers. EABL, a few weeks ago, we mentioned that it's seeking an early redemption, so it's getting out of that market. The other issues, Centrum is actually an quoted securities platform whereby it's not open to the public. And the other issues are quite small issues. I think real people amongst the other. Econ is also gradually delisting from the corporate bond. So at least Family Bank is a repeat issuer. It has a track record. So on the borderline, we're not seeing risks materializing. And I'm not saying that because we're one of the lead transaction advisors, but from the fact that it's a repeat issuer, not seeing any risk that might crop up. Of course, there's been issues.
Thanks,
yeah.
All
Thanks,
right.
Tamarin.
All right, then maybe just to wrap up this discussion, could you speak about trading in the secondary market for the MTN? How would that take place? That's a question from Newton.
Yeah, it's usually the same way that you can also trade the government bonds. It's only that now the liquidity. So that's the other, perhaps the risk that could be there, because it's 5 billion and people are just sticking out for the long term. So if you might want to exit in between, you might find it a bit challenging. So that's probably one of the risks that an investor might get. And that is also applicable not only to Family Bank, but also across the other issues. Remember that even in any given year, the turnover for corporate bond segment is roughly 0.1% in terms of its turnover and also in terms of the outstanding bond amount. So it's the liquidity here comes from the fact that, like here, we're looking at 4 billion, but a government bond that is issued is around 30 billion, and that's the least quantum that we are seeing. So that is where the quote-unquote liquidity comes around, because it's too thin. But just taking up for the long haul, at least it could be giving some decent returns for 13% fixed rates, 13% as compared to a 5-year, which is around 11%. So there's a bit of some premium over there, at least to compensate the illiquidity risk getting into the bond. So for an investor, you're looking at it to stick it out for the long haul. For trading, might be a bit difficult. And that's something we've seen not only with this particular issue, but across the corporate bond segments.
All right, then. Thank you so much for that, Churchill. You definitely enriched the discussion for MTN. I've dropped the email address in the chat box if anyone wants to take up the offer or continue the discussion. So we can move on to the other types of questions. We have Beryl, who wants to know a bit more about the rights market in Kenya. So Churchill, Wesley, Melody, could someone speak to that?
For the REITs, real estate investment trust, this is basically an avenue for an investor to get exposure to the real estate segment without actually owning a property. So far we have two different kind of rates. We have the income rate. Ideally, the one that is being the umbrella is ICLI on asset management, which Fahari iRate, but is now run by ICLI on asset management. So ideally, the key property that they have is the Green Mall property. Its previous anchor tenant was Tuskys. There was a switch of the tenant. I think right now is Naivas taking that space. So ideally, the proceeds from the rentals from that particular property is now what investors will be getting, will be distributed to investors. And I think there are other properties, I don't remember where they are, but there are other properties that are being managed by this particular IRIT. And then there's what Econ is pursuing, the development real estate investment trust, whereby they are developing properties. And as an investor, you can also get some units or some developments, or as they develop, you also can be part and parcel as an investor into that Econ. So those are the two routes that an investor can be able to get into A-REIT. But ideally, looking at the returns, we don't have much in-depth insights outside those high-level analysis, but it's something that we can pursue as a single, as a standalone webinar, just to look at the opportunities within the REITs. Damaris, perhaps we can organize one.
All right, then, thank you. I think my only other question, I know they're listed on the, or rather if you even go on the Jacuzzi app, you can see them listed as something you can trade in. Is that correct?
On the app, I'm not quite sure whether it's also there, but so because they're listed securities, I believe they might be part and parcel of the instruments that are on the app.
All right, then, thanks so much. Anthony asked, do you think NMG will be able to stay at current levels or even rise higher? The fundamentals haven't improved much, and the share buyback seems to be the only reason for this price rally.
Well, last week, from the start of the week, it was 22 shillings and 60 cents. It closed at 22 shillings and 90 cents. Obviously, it was muted as compared to the prior 2 weeks. We saw some rally from 17 levels to all the way to 22.6 the prior week. So yes, the share buyback announcement definitely is a big is what propelled the rally in NMG to where it is. The AGM is expected to be Friday the 25th, and then once it's been approved by shareholders, it will now start. NMG management will now start the active buyout of at least 10% of the outstanding shares in NMG from the 28th of June. So that's roughly 2 weeks away. In the event that the AGM gives it the nod for the share buyback price. So at the moment, and that is also what, if we go back to our weekly reports for the investors who receive our reports, we have some cautiousness on NMG as a trading idea, for the simple fact that we just have, it's like 9% from the close price of last week to the maximum buyback price of 25 shillings. It's just roughly 9%. And then the market action is more geared towards, at some point it was geared towards buyers, but not people are selling at this point. So even the dynamics, if you want to buy into it, there are no sellers too much. So I don't know whether these dynamics will also play in the event that that share buyback has been approved. I remember that we are operating with a ceiling of 25 shillings per share because that's the maximum buyback price. So, but nonetheless, it's within a range between 2 shillings and 50 cents all the way to 25 shillings. That's where NMG will be buying back the 10% outstanding shares within that level. So it's still a wait and see. The sequence though is the AGM to approve the share buyback, and then it starts trading from 28th of June.
Okay, thank you, Churchill. On to our last couple of questions. Kamal had two. He asks, how will the energy reforms impact on Kenya Power shares for the long-term investor? And secondly, which counters will benefit the most from the budget besides the banks?
Wow, I don't know whether my colleagues can also chime in. Anyway, Kenya Power, we just wait to see these particular reforms that have been posed by World Bank. They're just looking at pivoting away from the feed-in tariffs that is currently playing out and looking at alternative tariff routes that will at least reduce the cost on Kenya Power. The cost savings over 10 years, this is the preliminary estimates, is around $1.1 billion over 10 years. So the execution is what will also determine how at all these cost savings will be realized. So from that perspective, we are still at a wait and see, a look at how the specifics to this Kenya Power proposal, the reforms on regarding Kenya Power. I mentioned earlier on, even with IMF, they had flagged Kenya Power as one of the utilities, as one of the state-owned entities that has some of the biggest risks, fiscal risks in Kenya's any given financial year. So I don't know even the specifics around how it will be restructured. So from at least we know from the World Bank report that came out, or the World Bank, this particular financing facility, there's mention about some high level cost savings. The specifics is what now needs to be implemented. On the other hand, from the IMF perspective, Treasury had mentioned that it will have restructuring of some of the state-owned entities. We don't know whether it will be running in parallel to what World Bank has said. So it's just a wait and see in regards to the electricity reforms. The other issue regards which other banks will be beneficiary from the budget. We put out a report last week just giving our views on which will be the beneficiaries. For investors, I think by and large, there are those counters, I think we mentioned like 13 or 10, I don't remember the number, that usually quote unquote have dividend plays by the virtue that government has some shareholding stake in those companies. Safaricom, 35% shareholding by the government, KCB, 17% shareholding by the government, Kenya Re, 60% shareholding by the government, and consistently those names have been issuing dividends. So from a dividend play, there are those names, at least because of the government. Remember that on above that ordinary revenue figure that I mentioned, 1.78 trillion, underlying those numbers, we have tax income, so income tax, we have value added tax, import duty, excess duty, and also we have investment income. So investment income is now the dividends that is paid back to the government by some of the state-owned entities or listed entities that are linked by the government. Safaricom topping the list. So there are those names that by the virtue that quote unquote the government is relying on them to pay out dividends, they still continue being dividend plays for investors. So from that headline number we are looking at, there are a few names that we put out there, and even in the current financial year, they have been able to pay out dividend. Kenya Power, in as much as it didn't pay the dividend, it has some preferred shares, the 4%, 7% preferred shares that it consistently keeps paying the government. I think in the order of 700,000. It's small, but at least it's something that the government receives from the names that are listed in the stock exchange. So that angle is what we pursued. Of course, looking at the specific, in general, the role that the government will play, of course, what we mentioned also in the report is this issue to do with the NPLs. Arrears, public arrears is something which is a thorny issue in the budget, and it had affected the banks. Most of the banks are saying that, oh, the rising NPLs is because the government is not paying its bills, but I think by and large, that is now priced in the market. So going forward, we don't see that it will be a positive surprise or a negative surprise that the government or banks will still continue mentioning that the pending bills by the government is an issue on NPLs, because we know that it has played out for a long time. It's not something which is surprising. So yeah, those are just our thoughts on how the budget will have an impact on the listed entities.
All right, then. Thank you so much for that comprehensive answer, Churchill. And I have a question for Matthew. So Matthew, I know the G7 summit concluded, and I just wanted to know if from the summit there are any things we should be taking note of that are going to affect the global economic market.
Okay, good question. From the G7, I think the major bone of contention there is on taxes, because you see the US, we have the G7 and the G20. The US has been trying to have the taxation standardized in such a way. So that's one of the key things that we need to watch for the developments, whether the G7 is going to agree to that and whether the other countries are going to agree to that. So from the G7, the key things we need to see how it plays out in the future is whether they agree on a standardized level of taxation.
Thanks, Matthew. We have a question from Titus. Churchill, I feel like you probably touched on this a bit, but let's just address it specifically. Titus is asking if we want to perform best during these times of high inflation. Or maybe Melody or Wesley could tackle this question.
Maybe I can just give a suggestion. For me, I think it's the companies that have the power to raise the prices easily. That's mostly companies like that deal with energy and industrial things like KPLC, Bamburi, EIPL. I don't know what Churchill thinks about that.
Just to get it right, Melody, you said it's the companies that have the ability to raise their prices.
Yes.
Okay, all right.
Maybe
Churchill,
I can join in.
thoughts?
Okay, Churchill.
Oh, Matthew, go ahead. No,
Churchill.
Matthew, go ahead.
Okay, all right. Yeah, I think during this time of inflation, when you're looking at the stocks, mostly it's the cyclicals are likely to be performing better. If you just have a look at just a sample, a few of the cyclicals, that is the companies, the stocks which are in the companies that are more of consumer, that's the products that people are likely to consume on a day-to-day basis. That's the what we're talking about: apparel or design, clothes, food, and even energy, just like Melody has mentioned. So, if, for example, if we look at Coca-Cola, has been rising for quite some time, so the stocks have been performing better. Walmart as well, and even on the airlines sector, they're performing better. But I don't know if that's the case for our local airline stock. Maybe Churchill can speak more about that. But mostly during inflation, it's more on the stocks that, again, the companies that can keep on raising the price of their product, just like Danu Melody has said. So yeah.
I have learned something new today. I've never viewed stocks in that term, but that is very logical. If they're also able to raise their prices to the end consumer, then they're able to keep up with the inflation. And then for the investor, it probably makes sense to invest in those companies. Thanks, guys. I've learned something new today. I think let's tackle the final question from William. William wants to talk about exchange traded funds, how they work, and if they're a good investment. So who's going to tackle this final question for our Monday morning?
Well, the exchange traded funds, the ETFs, are listed investment products that track the performance of a bucket of shares, bonds, and commodities. And in terms of ETFs that are traded are the indices, the equities, debt, and commodities, and other physical assets. Well, from a risk perspective, ETF hedges from industry-specific risks because it covers a bucket of shares. It is a good investment, especially for portfolios, for an investor who views their portfolio to be a risk-averse portfolio. So it would be a good investment for an investor who wants to hedge risks, since it hedges from the industry-specific kind of risks. Back to you, Damaris.
Thank you so much, Wesley. Matthew, I see you're also unmuted. Did you want to contribute to this question?
Well, maybe just support what Wesley has said. You see, an ETF is where it's like an index which has been constructed to track performance for specific, maybe collection of instruments. For example, the common one is the ABSA Gold ETF, right? So it's just tracking the performance of the gold. So I think it's something good, because most of the times you can use it to hedge against the movement. If, for example, there's plunging of the markets, you can take an advantage and just do short selling. If it's performing better, then of course you can take advantage and go long. So yeah, just to support what Wesley has said.
Thank you so much for that, Matthew, and thank you, Wesley and Melody, and of course, thank you, Churchill, for this discussion. I believe we've answered all the questions which were sent in the Q&A, and we shared the required information in the chat function. If you need to continue the conversation with us, please find us on the different social media platforms, and we'll be happy to engage. Otherwise, let's meet next week, Monday. Thank you so much, team, for an interactive session, and have a great week, everyone.
Right, Damaris, maybe before you end, sorry for getting in when you've already completed. I just want to recommend everyone who is here. I've been getting fewer and fewer questions getting along. Feel free to try out this Forex trading. You have an opportunity of learning for free on the demo account. Just go register a demo account on FXPesa and start learning for free up until you feel comfortable. That's when you go to live trading. So I just felt it's good to mention that one. We have got webinars to support our clients. If you're quite new in it, we take you through from the beginner level all the way to advanced levels, and it's something that you can practice, and it's for free up until you feel confident. So yeah, I want to get that engagement more. I would like us to discuss a little bit more into the global markets, and of course, as we get along with Churchill, Damaris, and the rest of the team here on our local financial instruments. So thank you. See you next week.
See you next week. And thanks, Matthew, again, and team. Have a good one.
All right.